Hi guys, good evening and welcome to Markets Weekly right here on Moneycontrol. I'm Karunya Rao and like every week I'm back once again to give you a detailed wrap of the market, the big trends that are playing out and of course helping our retail audiences, retail investors to plan their finances, their investments in a better, prudent way, tracking the big developments and trends of the market. Joining me in conversation today is Harsha Upadhyaya from Kotak AMC. Hi, Harsha. Thank you so much for taking time out.
Thank you. My pleasure.
First things first, I want you to tell our viewers what exactly is happening in the Indian markets vis-a-vis the global markets. Because what we have been coming across in terms of news reports, discussions, analyst reports as well, is that Indian economy is resilient compared to other global markets. Why is it that we have done much better than our peers and even bigger markets?
Karunya, it's very clear that we have been more resilient than other economies. I think the fact is the negative real rates in our economy are much smaller, and to that extent, we'll need only smaller quantum of rate hikes as we go forward. Whereas if you look at some of the developed economies like US or Euro region, their inflation is much higher than our inflation. Their interest rates are much lower. If you recall, post global financial crisis, they had actually gone down to very low levels of interest rates for a long time. So that's where they need to do heavy lifting in terms of making sure that there is some positive real rate in the economy. While doing that, their economies are likely to get affected in terms of growth rates, much more than what we would see in Indian context. Yes, even India is going to see some different growth, but overall, when you look at global context, I think India will look like oasis in the desert, wherein our growth is going to be more resilient as compared to recessionary trends that we are seeing in some of the developed markets. And I think this is what is leading to a kind of slightly divergent market performance, I would say, wherein India has done relatively better than some of the developed economies.
That's right. But what really has puzzled or baffled investors, especially retail investors, is the fact that if the macros are, yes, relatively better, but not looking very good in a standalone setup. So why are the markets cheering, economic slowdown of sorts right now? And like you said, there could be a downturn. Will it be something similar to what we're seeing in bigger markets? Will we mirror that kind of a move, or will the downturn also be less painful?
No, not at all. We are not going to mirror that trend. Maybe directionally, we will have some impact in terms of growth rates. At the minimum, we are likely to have 6.5% kind of GDP growth rates even going forward, which is very, very different than the recessionary trends that we are seeing in other markets, for example. So, to that extent, while the valuations may remain on the higher side, given the fact that a lot of money has flown into India in the recent past and market has not corrected to the same extent as other markets. But from a long-term perspective, I think India will still continue to be one of the favored investment destinations. And also, when you look at corporate profitability, and that's clearly on an uptrend. Yes, the commodity price inflation, maybe a little bit of sluggish demand in the interim could impact earnings for 1 or 2 quarters. But from a longer term perspective, I think India is expected to deliver reasonably strong double digit earnings. And that's what is going to drive the markets in the medium to long term.
Right. You were talking about commodity prices and not just commodities, but across asset classes, we have seen a very massive amount of volatility coming in. So, when different asset classes are under pressure at the same time, what should be one's strategy and how should you go about picking what is right for you and make it work?
Karunya, I couldn't hear complete sentence of yours. Can you please repeat that?
Yeah, I was saying that, when there is a complete instability or uncertainty across asset classes, not just commodities, but also there is gold, cryptocurrencies, equity markets, across different assets, we're seeing this volatility creeping in. So, what should one do right now at a time like this when it comes to their investing strategy? How should they decide which asset works best for them and how to go about it?
See, I think it's the time-tested principle that will work across market condition, and especially in scenarios where there is more volatility. I think the first rule is not to chase momentum because when volatility is high, it's going to be a lot of sharp movements in the market on both sides. So one should not really chase momentum, but do proper fundamental due diligence in terms of which asset class to invest into, which portfolios to invest into, which stocks to invest into. I think that should be the focus area. And also, asset allocation is going to become very, very important because if you skew your asset allocation, then in the very short term, it may look very good. But given the volatility and how various asset classes are likely to move over the period of time, then you could have very different results than what you're really intended for. So, to that extent, both asset allocation as well as not chasing momentum would be the right tools to actually follow at this point of time.
And what kind of asset allocation do you recommend your clients, or even people who approach you with their grievances or worries amid times like this?
Currently, given that the market valuations are around the fair level, when you look at historical context and also in terms of how the short-term volatility is going to be affecting corporate profitability, etc., we are suggesting neutral weight to equities, which means that obviously it's not one size fits all kind of a asset allocation, but a person if he's intending to take, let's say, X percent in equity, this is the time to be around that X percent, which is neutral weight to equities. And within equities, we are suggesting a slight tilt towards large caps, where we believe there will be more steadiness in terms of earnings and also lesser volatility. Simply because over the last couple of years, the mid and small caps have outperformed large caps in a very big fashion. So to that extent, if there is nervousness in the market, there could be a little more of profit booking in those segments. And also, usually when there is a macro challenge, large cap companies tend to do much better than mid caps and small caps. So that's the only small adjustment that we are asking clients to do at this point of time, taking a small tilt towards large caps vis-a-vis mid and small caps, whereas keeping neutral weight to equities.
All right, that makes sense. I want to talk to you about two ongoing themes in the market right now, in domestic market right now. One, of course, is the festive season. Um, how do you think the season is going to pan out across the board? Because this is, a significant part of exposure of a lot of consumption companies, consumer-facing companies. They do rely on the festive season for a significant part of their, revenue and even earnings overall. So this time around, what is your assessment? Any pockets of the market that look good vis-a-vis the others?
Across the board, we believe that this festive season is going to be much better compared to last two previous festive seasons. The reason being one, this time the COVID is not really creating any disruption. And to that extent, the postponement or the delays that have happened in consumption over the past 2 years, that's going to come back in terms of higher demand this festive season. So we are expecting that to impact almost all of the consumer categories across the board. However, we believe that the rural economy might be little slower as compared to urban economy because that's where we have seen a larger adverse impact of COVID. There, it could be little lower consumer confidence as compared to the urban area. But overall, we do believe that the consumption situation during the festive season should be much better than what we have witnessed in the year 2020 as well as 2021.
But do you think it will be as good as it used to be pre-COVID, or could it surpass those levels as well, perhaps FY20 levels?
We do believe that it can be as good as financial year 2019-20 kind of
Okay.
festive season. But I mean, these are early days. We'll have to wait and monitor how it pans out over the next few weeks. But clearly, we believe that at least the urban part of consumption should be as good as what we have seen a couple of years back.
When we talk about festivals, we typically talk about redoing our houses, cleaning up our workspaces, etc. But when it comes to cleaning up your portfolio, what would be the advice you want to give to our viewers? Because typically a lot of WhatsApps, a lot of social media chatter, a lot of pics start coming your way, especially closer to the festive season. That oh, this theme will do well from Diwali to Diwali, or these stocks are likely to gain more than the others, some such. But talk to us about how to stay clear from the clutter and how to declutter your existing portfolio as well.
One is clearly the businesses don't change because there is a calendar month change or a calendar year change, or there is a festive season that comes this year and comes back again next year, etc. So I think just to make those changes because somebody is sending out messages or somebody is suggesting is not the right way to proceed. Clearly, one needs to have a long-term focus in terms of whichever portfolio you are constructing. If you are not able to construct that portfolio on your own, please take the advice of financial experts who will be able to manage your overall risk tolerance, risk appetite, and also your liquidity needs and wealth goals, etc., and suggest a proper asset allocation because that's the key for long-term sustainable wealth creation. Whether it is Diwali, whether it is New Year, I think these are some of the basic facts that one needs to continue to focus, and that's what we would suggest. And as far as the portfolios are concerned, clearly it's not just because of Diwali cleanup. I mean, every time you need to monitor your stocks, look at fundamentals, look at whether the companies are progressing the way one has envisaged. If not, whether those are transient challenges or long-term challenges. Accordingly, you need to make changes to the portfolio. And also, at every
Mm.
point of time, needs to keep looking at valuations to see whether both from an absolute perspective as well as from a relative perspective, those sectors, those stocks are in line with what your intention is in terms of keeping the valuations at a certain level for the portfolio. So I think these are the basic things. And if these issues confuse a retail investor or a layman investor, then I think it's better to take financial experts' advice and proceed rather than just going by what comes in some of the social media forwards or elsewhere.
Right. Okay. The second theme I want to touch upon is the earnings season. Of course, from Monday onwards, we'll have the IT bellwether TCS numbers coming in, and thereafter, of course, a slew of other companies will start reporting the numbers for the second quarter and for the entire first half of this fiscal as well. Let's talk about IT sector first, because that is something that has been in a tough spot for many weeks or rather months now. Uh, Many of these IT companies are bracing against inflation given their extremely high global exposure. Now, do you think that the momentum in the Indian IT industry could see some uh, hiccups or some speed bumps? Because, yes, the long term story is intact. But over the near to medium term, do you think there could be some challenges for the entire IT space?
Yes, we do believe that there could be issues in terms of sustaining the current business momentum going forward because one, these are more exposed to developed nations such as US or the European region. And these are also exposed to banking and financial sector in those economies where there is some amount of stress that is coming out in public. Clearly, last year's budget, that is the 2022 budget, when it was made, things were not as bad as what we are currently witnessing. There was no fear of a recession. There was no real geopolitical issue that one was expecting, etc. So, to that extent, the IT budgets were really strong coming into 2022. But as we look at 2023 IT budget, we believe that there are various macro headwinds for companies to really ponder about. And to that extent, either there will be some curtailment in IT budgets, especially the discretionary IT budgets, or there could be some postponement in terms of some of the deal closures, both of which are likely to derail the business momentum for IT companies, in our opinion. So, to that extent, I think the kind of strong business momentum that we had seen over the last 2 years, especially from the lows of the COVID, is unlikely to continue in the near term. So to that extent, one needs to be cautious. And also the valuations, while they have come off quite significantly from the peak level, they are still one standard deviation above the average valuations for the sector. So to that extent, we do believe that the valuations have not fully discounted the kind of pain that could be coming in the next few quarters.
What about the rest of the space? Any sectors do you think could be outliers or outperformers, in the quarterly results that are yet to be declared? Because last quarter, yes, it was a weak quarter. It was largely unexpected. In fact, some of the companies' commentary and numbers were slightly better than expected, though they were still, below par. Talk to us about who could be the outliers this time around. Any sectors that you guys think could actually, surprise positively, perhaps?
Definitely, on a relative basis, we do believe that banking and financial services, especially the large banks and automobile sector, could be the sectors to watch out for. Both of these seem to be doing well in terms of the growth. In the banking segment, we have seen credit growth consistently inching upwards, and also in the auto sector, we have seen the volumes going up on a monthly basis. And we do believe that both these sectors should deliver reasonably strong margins, while in the auto sector, maybe it'll still be a lot more muted as compared to what they can actually achieve over a period of time. But on a sequential basis, I think both these sectors should be doing much better, and that's where, on a relative basis as well, market will find comfort, because they, as I mentioned, some of the other sectors could be witnessing a bit of headwinds as we go forward. Whereas these two sectors continuously seem to be progressing in the right manner, and looking at higher growth as we go forward.
But the auto sector, do you think it's still attractive despite the massive run up many of these stocks have already seen this year? Are the valuations still looking okay?
In the very short term, there is no room for further re-rating of these stocks. But if you're betting on the entire cycle to play out over the next 3 to 5 years, I think definitely there is money to be made there. Clearly, some of the headwinds that were there and which were impacting the companies, for example, one was the overall COVID disruption, which had led to a lot of demand delays and disruption. That is behind us. We have seen commodity costs correcting quite meaningfully. That should also help in terms of margins, as most of these companies have taken price hikes in the recent times. The new product launches that we have seen in some of these manufacturers have evinced a lot of interest from customers. So that should be positive for demand to continue as we go forward. And also the global issue of problems in terms of sourcing chips is also probably behind us, and that should also help in terms of normalization of overall deliveries of vehicles, as well as in terms of improving margins. So overall, we believe that from a medium to long term perspective, there is still money to be made in the auto sector. Whereas in the immediate short term, is, as you rightly mentioned, the stocks have run up quite meaningfully in a flattish market. So to that extent, one has to be really waiting for those opportunities to enter rather than just chasing.
Okay, but barring the earnings season, otherwise, any big trends emerging in the market that you guys are chasing or that you guys are keeping on your watch list, perhaps our viewers can also keep on their radar?
Clearly, if you look at the theme that we are looking at is more of for domestic focused businesses, as clearly the global growth is going to be at a significantly lower level for a longer time period as compared to our growth, which is going to be more resilient. So most of the domestic facing businesses are likely to do much better than some of the export stories of international plays. However, each of those segments have to be re-evaluated in terms of where the valuations are, and where the ownership is, and what's likely to happen if there is nervousness in the market in terms of profit booking, etc. But overall, I would say that a tilt towards domestic facing businesses should be better from a portfolio perspective.
Before we let you go, Harsha, I just want to understand one big learning perhaps that you have had in the markets this year. I mean, what we're witnessing, what many of the retail investors are witnessing, is perhaps something unprecedented. Many of them are seeing it for the first time. So many macro, geopolitical, global level events happening simultaneously. So, what has been the one big learning, and how are you implementing that when it comes to your strategy or your investing mantra?
I think one of the biggest changes that have happened in the overall market structure this year has been how resilient has been Indian economy, and how strong have been domestic flows. I think there was a point of time in the past where every time whenever there used to be outflows from foreign institutional investors, everybody used to believe that there would be mayhem in the markets and markets would fall. But I think clearly the strength in domestic flows and the counterbalancing force of those flows have really helped the markets to cushion that volatility, despite having seen almost four times the kind of outflows that we had seen during the COVID lows in the last 9 months, spanning from October 2021 to June 2022. Markets actually have weathered that storm simply because the counterbalancing domestic flows have been strong. So my advice to retail investors who usually track foreign institutional investor flows and believe that that is going to lead in terms of overall market direction. I think there has been a clear change in the market structure, and even the domestic investors have become equally strong in terms of flows. So it's not prudent to just look at foreign flows and assume that the market would take a certain direction.
All right. Well, I hope our viewers are, taking note of all of that, and they will accordingly devise their strategy, taking notes from you and learning from your observations. Harsha, thank you so much for joining in. Always a pleasure to have you.